Imagine losing $65 billion overnight. Sounds impossible? That's precisely what happened in the Madoff investment scandal. Now, let's put this into perspective. The sheer scale of this scandal is mind-boggling. We're talking about an amount that's greater than the GDP of most countries. Not just a handful, but thousands were affected. From ordinary individuals to high-profile celebrities, no one was spared. Hollywood icon Steven Spielberg and Hall of Fame pitcher Sandy Koufax were among those who found themselves in the eye of this financial hurricane. Just think about it. One day, you're sitting on a mountain of wealth, and the next, it's all gone, vanished into thin air. Now, that's a plot twist even Spielberg himself wouldn't have seen coming. And all this leads us to one burning question. So how did one man manage to pull off such an enormous fraud? Before the scandal, Bernie Madoff was a respected figure on Wall Street. Our story begins with a young Bernie Madoff, fresh-faced and eager, launching his career in the finance world. His journey to Wall Street greatness started off humbly, with a job as a penny stock trader. Showing an early knack for the stock market, his ambition quickly propelled him to establish his own firm, Bernard L. Madoff Investment Securities, LLC. The firm, which began as a two-man operation in the late 1960s, grew exponentially over the decades. It became a significant player on Wall Street, handling up to 5% of the trading volume on the New York Stock Exchange. Madoff's reputation as a financial wizard grew alongside his firm, and his charm and charisma made him a magnet for investors. But what really drew in the investors was his promise of consistently high returns. Madoff was the golden goose of Wall Street, seemingly able to produce returns of 10 to 12% every year, regardless of the economic climate. This consistency, unheard of in the volatile world of finance, made him a beacon for investors looking for steady growth. His clients, ranging from individual retirees to massive hedge funds, were all enchanted by the allure of steady, secure profits. They trusted Madoff, not just because of his charm and reputation, but because he delivered on his promises. Every month, like clockwork, investors would see their investments grow. Madoff's rise was meteoric, his success seemingly untouchable. He was the embodiment of the American dream, a self-made man who had crafted an empire out of nothing but his own grit and determination. He was a beacon of hope for many, a symbol of what could be achieved with hard work and a little bit of luck. But as we now know, those returns were too good to be true. In December 2008, the house of cards that Madoff had built came crashing down. This marked the beginning of the end of a financial empire that had once seemed invincible. The events leading to Madoff's arrest were as dramatic as they were unexpected. It all began when Madoff confessed his crimes to his sons, Mark and Andrew. He admitted that his wealth management business was, in truth, a colossal pyramid scheme. His sons, shocked and betrayed, made the tough decision to report their father to the authorities. And so, on a cold December day, the man who had once been a Wall Street titan was arrested at his Manhattan penthouse. The news sent shockwaves through the financial world. Madoff, the man who had been trusted with billions of dollars, was now a pariah, accused of orchestrating the largest financial fraud in American history. The public's reaction was one of disbelief and outrage. How could a man so respected, so admired, have perpetrated such a massive fraud? The victims of Madoff's scheme ranged from ordinary individuals who had trusted him with their life savings, to celebrities, to even charitable organizations. Their losses were staggering, their dreams shattered. The immediate aftermath of Madoff's arrest was chaotic. The news of the scandal dominated headlines. Investors panicked, markets trembled, and the name Madoff became synonymous with deceit and betrayal. The fallout was swift and severe. His victims were left to pick up the pieces of their shattered lives, while Madoff himself was left to face the consequences of his actions. Madoff's arrest marked the end of one chapter, but the consequences of his actions were far from over. His victims would spend years trying to recover, and the financial world would be forever changed. The Madoff scandal served as a stark reminder of the dangers of unchecked greed and the importance of oversight and accountability in the world of finance. In the wake of the scandal, investors were left picking up the pieces. This was no easy task. Billions of dollars had vanished, and trust in the investment world had taken a significant hit. Recovery efforts were launched in earnest. The Securities Investor Protection Corporation, or SIPC, stepped in to assist. The SIPC is a non-profit organization that helps investors when a brokerage firm fails. They worked tirelessly to recover funds for the victims, and while it was a daunting task, they managed to claw back a significant portion of the lost funds. But money wasn't the only thing lost in the Madoff scandal. Trust in the investment world was also shaken. In response, regulatory bodies and governments around the world began implementing reforms to prevent similar frauds in the future. These included stricter oversight of investment firms, more rigorous auditing processes, and harsher penalties for those involved in fraudulent activities. And then there were the lessons. Lessons that are just as relevant today as they were then. The first is the importance of due diligence. Never invest in something you don't fully understand. Always do your homework and don't be afraid to ask questions. The second lesson is skepticism. If an investment opportunity seems too good to be true, it probably is. Madoff promised consistent high returns regardless of market conditions. This should have raised red flags. Remember, high returns come with high risk. There's no such thing as a free lunch in the investment world. Lastly, diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes and sectors. This helps to mitigate risk and ensure that a single investment gone wrong doesn't wipe out your entire portfolio. So, as we wrap up our exploration of the Madoff scandal, remember, if an investment seems too good to be true, it probably is. Let's hope the lessons learned from this scandal continue to guide us in our investment decisions and help us avoid similar pitfalls in the future.